All right, let's dive in. Today, we're going to crack open the book that Warren Buffett himself called by far the best book about investing ever written. We're talking about Benjamin Graham's The Intelligent Investor. Now, this book is old, nearly 80 years old, but its wisdom is absolutely timeless. And really, it all kicks off with one huge question.
And this is it. This is the question Graham says will define your entire financial future. So you've got to ask yourself, are you truly an investor or are you a speculator? Because this really is the core choice. Before you ever put a single dollar into anything, you have to understand the massive difference between investing and speculating.
Graham's definition is, well, it's crystal clear. There are three key parts here. Thorough analysis. That means you do your homework. Safety of principle, which is really just a way of saying, don't lose your money. And an adequate return. You're looking for a reasonable profit, not a lottery ticket. Anything that doesn't check all three of those boxes, according to Graham, that's just pure speculation.
You see, speculators, they get totally seduced by a good story. They chase the hype. And Graham warned us, just because an industry is growing like crazy, think about the internet back in the late 90s, that doesn't automatically mean your investment will too. In fact, a lot of the time it means the exact opposite, because everybody else has the same obvious idea.
Let's look at a classic example from that dot-com bubble, a company called Inktomi. In early 2000, speculators were just so ridiculously euphoric about this company that they valued it at, get this, $25 billion. To give you some perspective, that was 250 times its actual revenues. Come on, they weren't buying a business, they were buying a fantasy.
And here's the inevitable crash. Just 30 months later, that's 2.5 years, Inktomi's market value had completely collapsed to under $40 million. The business didn't just vanish, but that speculative fever, it broke. And it wiped out fortunes along with it. That, right there, is the price of participating in folly.
So if speculation is so incredibly dangerous, why do so many of us do it? Well, Graham argues that the biggest risk you face in investing isn't the market. It's the person you see in the mirror every morning.
We are all just wired with these biases that can make us pretty terrible investors. We panic when we see red in our portfolio. Barbra Streisand even admitted, if I see red, I sell my stocks quickly. We make a lucky bet and we confuse it with genius. We get overconfident. And maybe worst of all, we just follow the crowd, which often leads, right off a cliff.
So here's the key takeaway. Mastering your own emotions is way, way more important than mastering some complicated spreadsheet. The whole game is really about developing the right temperament.
Okay, so how do you keep your cool when the world around you is going completely mad? Graham gave us this brilliant mental tool, this imaginary business partner he called Mr. Market.
So just imagine you own a piece of a business, and your partner is this guy, Mr. Market. And he is a total emotional wreck. Every single day he shows up and offers to either buy your shares or sell you his. But here's the thing. His prices are based entirely on his mood, not on the actual value of the business. And the secret? You don't have to listen to a word he says.
When Mr. Market is euphoric, screaming that prices are going to the moon, the speculator gets all swept up in it. They have this fear of missing out, so they buy. But the intelligent investor, they see a golden opportunity. They either just ignore all the noise, or they happily take advantage of Mr. Market's good mood and sell him their shares at a fantastic price. And on the flip side, when Mr. Market is depressed, totally convinced the world is ending, the speculator panics and sells everything. The intelligent investor, though, sees something completely different. They see a fire sale. They calmly and rationally take advantage of his pessimism to buy great businesses at a huge discount. And this brings us to what might be Graham's single most important idea in all of investing. It's the ultimate defense against your own mistakes and the madness of Mr. Market. It's called the margin of safety. Seriously, the margin of safety is the central concept of this whole book. It's not about trying to avoid risk altogether. That's impossible. It's about preparing for it. It's the buffer zone that makes sure a simple mistake doesn't turn into a total catastrophe.
And applying it is actually a pretty simple two-step process. First, you do the work. You figure out what a business is actually worth, its intrinsic value. Then, second, you just wait patiently until you can buy it for way less than that value.
The math here is really simple. Let's say you calculate a stock is worth $100 a share. You don't buy it for $95. No way.
You wait for Mr. Market to have a really terrible day and he offers it to you for $60. That $40 gap, that is your margin of safety. It's your protection. It's your cushion for being wrong because you will be wrong sometimes.
Okay, so let's bring all this together. Being an intelligent investor isn't about knowing a handful of tricks. It's a lifelong commitment. It's a whole different way of thinking.
And you might be asking, does this stuff actually work? Well, Graham's most famous student, a guy you might have heard of, named Warren Buffett, says these principles are the bedrock of his entire legendary career. The proof really is in the results of those who followed Graham's path. So, I'm going to leave you with this vow, which is adapted right from the book. This is the mindset of the intelligent investor. You refuse to let the herd make your decisions. You never buy just because prices are up, and you never sell just because they're down. You remember, always, that price and value are two different things, and you always, always insist on a margin of safety.
At the end of the day, Graham leaves us with a very clear choice. You know, in the wild theater of the stock market, you can either be an actor on the stage, getting swept up in all the drama and madness, or you can be the cool-headed observer in the audience, profiting from the folly you see playing out. The choice is yours.